The market finds itself in a state of extreme fear after witnessing the price of Bitcoin fall, affected by the movement of the holders and the aggressive approach of the Fed to tackle inflation. In this weekly time frame, we see how, in the last 2 weeks, the markets found itself in a significant correction period. In the week between March 28th and April 3rd, we saw a candlestick that showed clear indecision. This was confirmed later by the downward trend between April 4th and 10th, with a full-body engulfing candlestick closing below $43,000. As the week draws to a close, the candlestick touched the area around $39,000. This takes us to an important support between $39,000 and $38,000 approximately, meaning that if we were to see a candlestick closing below this area, it would be a sign of a continued bearish trend. As the averages unfolded, we saw how the bearish candlestick between April 4th and April 10th crossed the averages of 50 and 20 periods. The latter is well on its way to trying to break the support zone. If the range between $38,400 and $39,200 were to be broken, it could test the 100-period moving average. Studying Bitcoin's daily structural chart, we can see how a strong downward movement after losing the area around the $44,000 and $45,600, as discussed in our last analysis after witnessing candlesticks close between $42,000 zone, the downward trend is being tested as the price touched the $39,000 zone on April 11th. As we have previously mentioned, due to being trapped in a structure such as this one, it was always a possibility to see a pushback. If candlesticks begin to close at the bottom of the channel located at the $37,000 zone, it would be an indicator of a bearish trend. In this daily time frame, we see a major support trend. If we were to lose this zone, however, it would test the $37,000 zone, which converges at the 0.78 Fibonacci. The moving averages on the daily chart show us how all of the averages have been lost. After looking for the upward reversal on April 13th touching the 100-period zone, it returned to the trend guideline area whilst waiting for markets to close. If we see candlesticks closing below the $38,500 zone, the price could go on to test the support zone that converges with the 0.78 Fibonacci located at the $37,000 range. If the pullback were even bigger and we saw candlesticks closing below the ellipse, the price will test the last major zone that maintains consolidation above the realized price of whales. This zone covers the $33,000 and $35,000 mark. If, on the other hand, we were to see a pullback, it could test the $42,000 area once more. If we witness candlesticks closing above this area, however, it would go on to touch the 0.61 Fibonacci. In the S&P 500 index, we can see an upward boost. It currently sits at a support located at approximately 4,400 points after falling from 4,620 points, coinciding with the decline of Bitcoin. If the S&P continues its downward movement, Bitcoin would follow the same path. In the Fear and Greed Index, we have seen the return of extreme fear after going from neutrality to fear last week. With regards to Bitcoin reserves, we see how the flow of Bitcoins out of exchanges continues. This is important as it shows that there is still confidence in the coin as holders maintain their position. We can see investment funds are withdrawing Bitcoins from their balances, reducing it by approximately 10,000 BTCs. This movement is highly important as it is one of the factors that has led to the fall of the price. The whales have also reduced their positions, presenting another cause for the downward movement. There have been some significant purchases, but it has not been enough to offset the Bitcoin sales by the large holders. In this graph, we see that the average price of purchases by the whales is $34,500. This area converges with the guideline that stems from behind, marking the trend. This makes it the last important support zone in the short term to maintain consolidation of the price, as we commented at the beginning of the analysis. Last week we talked about the publication of the minutes of the Fed's last meeting, and this event is still affecting the market. The Fed's aggressive approach to inflation has led to the idea of raising interest rates by 0.5%, in addition to a reduction of its balance sheet by $95 billion in bonds. As we can see in the graph with the labour statistics of the United States, all items are at 8.5%, except only for energy, which has experienced an incredibly high inflation of 32%. In this breakdown, we can see how inflation affects all types of energy, hence the decision of the Fed that we mentioned. In addition, we can see how important May 3rd will be, as it is when the Fed will be meeting again. The target rate probability shows the current position with respect to future decisions, making the belief in a 50-point hike crystal clear. To summarize, the market has gone from neutrality to extreme fear after watching the price of Bitcoin fall, dangerously approaching the support zone marked in red by the whales, between $33,000 and $35,000. In addition, the Fed's aggressiveness in curbing the high inflation rates suggests that the market will continue with its current instability until the meeting on May 3rd. We will check back on all of this in the next weekly analysis.